Welcome to another edition to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. And this is the show that we do live every Tuesday to help you learn the ins and outs of passive real estate so you can go into your next deal with confidence. And so if you haven't done so already, make sure that you go to PassiveInvestingWithWhitney.com. Make sure that you have signed up for all of our future Masterclass sessions and our skills boot camps that we hold monthly. And there you can also see our open deals that we have here at PassiveInvesting.com. And if you would like, hop on my calendar and we can have a one-on-one conversation on how passive investing might fit into your personal real estate portfolio. All right, guys, as people trickle in today, we are going to tackle the topic of depreciation, right? It is December 2023. And I know this is the end of the year. A lot of people have made their investments for the year. But for those of you who are sitting on extra, cash, I mean, for me, I know it's been a slow year investing just because the wealth of deals that have come through the pipeline just wasn't there in the early half of the year, or the quality deals wasn't there. And so it's been a really challenging investing year, I think, for most of us who are full-time passive investors. But I want you to understand two things out of this webinar. One, we're just going to talk about the benefits of depreciation in passive real estate, right? We're going to help you connect those dots. But two, we want to also talk about if you're in that position, if you're listening to this in December 2023 and going, man, Whitney, I would like to lock in a position on a high quality cash flowing deal right now that throws off a lot of depreciation. Let's talk about the type of deals that could be that you could be looking at right now. All right, so let's kick it off. I always like, kind of orienting people to what it is we're talking about, why it's so important, and then how to do it. But before we launch into that, if you and I are just meeting for this first time, again, my name is Whitney Elkins-Hutten. This is the whole reason why I invest in real estate, and more importantly, why the bulk of my portfolio is in passive real estate. So this is me and my crazy crew right here. Last year in Sedona, guys, if I took down the green screen right here, you would see that we are back in Sedona right now, enjoying our time here in the winter, in the sun and fun. But anyways, this is the whole reason why I invest in passive real estate. I started off in 2002 as a live-in flipper and house hacker completely by accident, and did really well at building up buckets of equity. But over the course of the next 7 to 10 years, it finally dawned on me, I need to learn how to unlock these golden handcuffs. And that meant I needed to start creating cash flow in my life, okay, and taking advantage of tax benefits. And it was really hard to do for me with the style of investing that I was doing. So started, keeping some of the slips that we were doing and doing rental projects. And then later decided I need to go bigger in order to reach my financial freedom goals that I wanted to hit. So we got into multifamily investing. But then I was like, there's only so much I can do from an active perspective. How can I complement my portfolio? How can I take this cash, this equity growth that is snowballing on me, but put it into a vehicle where I can continue to take advantage of all the things around real estate, but do it in a much more passive manner, meaning I was truly getting mailbox money. And that's when we stumbled across passive or syndicated real estate investing. And once my husband and I did that, we dove in head first. And this is just our personal portfolio. We have over 6,500 multifamily units. I should say residential units. We still have a little bit of our own controlled real estate in that portfolio, 2,200 self-storage units, 15 express car washes. I actually should total up. We have quite a bit of debt investing as well. And, we've been talking a lot lately about our real estate debt fund here at PassiveInvesting.com. But we have a lot of note investments as well. We use that very strategically, to amplify our investing plan. But really, what you and I are both here to talk about is how can you, take all those vanity numbers and turn it into 100% choice on how you spend your time, okay? Now, a lot of people come here and they're like, I want financial freedom. I want 100% time freedom. That's great. But what most people actually want is the choice in what they do. They want to be able to get up and be anywhere in the world, do anything that lights their heart. And so, for me right now, like, I get to be here with you, educating you, but also I get to take my virtual home on the road and go play fun in the sun, mountain bike, hike, and all that thing. That's what lights my heart. But I still get to be here with you. And we can help you do that here at passiveinvesting.com. Here's some fun stats for us. We've made over 223 million in residential lending through our Rehab Wallet program. We have 1.4 billion assets under management, and we have some immensely strong returns too. Our passive investors, over 28.9% ARR, and made over 51 million in investor distributions. So if you haven't done so already, make sure to reach out to me. But now, we talk about those stats, but how do we get there? In learning how to leverage the different wealth pillars, if you guys have heard me talk so much about our wealth pillars there, taxes being one of them. It's not the only one, right? We've got capital preservation, we got cash flow, we have equity growth, we have tax benefits, we have 3 other pillars after that. But tax benefits, okay? We don't want the tax tail to wag the dog, so to speak. But how can we maximize our tax benefits? And especially when we got the clock ticking here on December 2023, okay? Now, since we are going to be talking about depreciation and tax benefits, I want to make sure that you guys are taking this education and taking it back to your investing team to make sure you understand how it would play out in your personal situation and in your personal portfolio. So this is not financial advice, legal advice, tax advice. Again, consult with your team before making any investment. All right, depreciation, right? That's one of the reasons, or tax benefits, and then depreciation being one of the largest tax benefits that real estate throws off. That's what attracts a lot of investors once they finally wrap their head around real estate, or excuse me, tax benefits and depreciation. They go, oh, it's cool to get cash flow and equity growth, but man, if I can tap into that tax depreciation pillar, that is where the rubber really meets the road. Okay, but let's get everybody on the same page. What is depreciation? At the end of the day, depreciation is an accounting methodology, okay, used to allocate costs of a tangible asset over its useful life, okay? So if we're talking about a piece of real estate, say like a multifamily building, and let's say the building is $1 million, if it's residential real estate, we could essentially take $1 million divided by 27.5 years. That's what the IRS tells is the useful life of a residential asset, and allocate that depreciation over 27.5 years. Okay, so that's what depreciation is. Simple math. Okay, the price of the property, what you purchased it for, divided by the number of years that the IRS says that you can depreciate. Residential real estate, 27.5 years. Commercial real estate, 39 years. And then even businesses like our express car washes, they get a whole other type of depreciation. And we'll talk about that later too. Now, accelerated depreciation, okay, this is something that, we can use it in, if you have a single family rental, you can use accelerated depreciation, okay, maybe a little harder, but we definitely do this on our larger multifamily projects, our self-storage projects. Okay, again, this is taking depreciation and amplifying it. It is still an accounting methodology, but we're changing the methodology. Okay, so what we're doing when we leverage accelerated depreciation is that we are going to do a cost segregation analysis. You see the acronym CSA on the screen. We're going to identify all the property related costs that can be depreciated in 20 years or less, according to the IRS. This isn't our opinion. This is what the IRS says. And we're going to speed up the recognition of that depreciation. Rather than taking it over 20 years, we're going to fast forward it to the first 5 years of the hold of the asset. Okay, that's very powerful. We're creating more business losses early to shelter income on the asset. Okay, it is that accelerated depreciation, since it's an accounting methodology, is one of the largest business subsidies in the tax code. Legal business subsidies in the tax code. All right. Now, as of 2017, and I shouldn't say as of 2017, but definitely before then, we have bonus depreciation. Okay. Before 2017, we had 50% bonus depreciation. Since 2017, we had 100% bonus depreciation up until 2 years ago, up until last year, I should say, in 2022. In 2023, bonus depreciation has gone down to 80%. And then next year, it's going to go down to 60%. Okay. This isn't an accounting methodology. Okay. This is a tax incentive. So our two methodologies of accounting for depreciation is our straight line depreciation and our accelerated depreciation. Now, bonus depreciation, again, is not an accounting methodology. It's rather a tax incentive that came out of the Tax Cuts and Jobs Act of 2017. And in that act, it said that businesses can take 100% bonus on qualified property through 2022, and then it starts phasing out. So this was the first year of the phase out. We're at 80% bonus depreciation. Next year, bonus depreciation will go down to 60%. Okay, still good. We're still above what it was in 2016, guys, which was 50%. But this is in a unique period of time for us to continue to invest in high quality assets and take advantage of this 80% bonus depreciation. We have until midnight on December 31st to lock that in. All right. So let's talk about the math. How does this all work, right? I kind of gave you a high level example, but let's break this apart. Now, guys, I am not an accountant, right? So this is very high level. Your our CPAs that do the cost segregation or help support the cost segregation analysis process on our properties, they've got the end all be all. They've got all the checklists. They're the ones running the math, okay? But this is going to help you from broad strokes level understand what's happening here, okay? So again, say we got that $1 million property, okay? And typically about 20% of a residential property is allocated to the land, okay? That varies based on your purchase and where the purchase is and all that. But generally about, mathematically average is about 20%. So we're going to allocate $200,000 to the land. Now, hey, the land doesn't break down, so we can't depreciate the land, right? But we can take that $800,000, okay, the difference between $1 million and $200,000, and according to the IRS, since this is a residential property, break that down or depreciate it over 27.5 years. So if we used option one, accounting methodology number one, which is our just regular plain vanilla depreciation, that would create a tax write-off, okay, 800,000 divided by 27.5 is about $29,000 a year in the tax write-off. But when we supercharge that, when we decide to do a cost segregation analysis and switch to accounting methodology number two, okay, we get to accelerate 200,000 of depreciation possibly to years 1 through 5. All right. And then that throws off another between what we can accelerate forward and what we could already take in straight line depreciation. Okay. And again, this is where your accountant is figuring all this out. You're going to get about a $69,000 a year tax write-off. Okay. Awesome. Way better than the $29,000. But again, we've got this tax incentive right now. Okay. In 2022, it's 80%. Starting next year, it's going down to 60%. Starting January 1st at 12:01 a.m., it goes down to 60% bonus depreciation. And that essentially allows us that $200,000 that we said we could get in accelerated depreciation. We don't have to wait 5 years to take that. We can take that all in year one. Okay. And I shouldn't say all, we can take 80% of it in year one right now. Okay. And so now we've taken that $69,000 in year one loss and potentially made it $160,000 in year one loss. Awesome. Okay. Now, again, this whole bonus depreciation incentive is phasing out. So again, we're in a unique time period right now where we can leverage that. All right. Now, what is the benefit to you as a limited partner investor? Because the example I just went over and illustrated for you is for somebody who is holding their own active real estate. Okay. The question that a lot of people might be asking, hey, I want to do this passively. I want to go into one of your multifamily deals or your express car wash deals. Does this apply to me? Yes. okay? Because all of that depreciation, okay, the way we structure our deals, and and this is always a question that you should ask any operator, is how is the depreciation? One, do you do a cost segregation analysis? And then two, how do you allocate your depreciation to your investors? Okay. So depreciation is the number one legal way to reduce your personal taxes by sheltering income. This is the income thrown off by the investment. Okay. Not your W-2 take-home income, but income from the investment. This could possibly, if you're able to shelter a lot of that investment income, and maybe even, if you qualify to be able to allow that to shelter some of your personal income, you might actually qualify for some other tax credits and benefits, right? Okay. But here, for most people, their largest expense is their personal taxes. Okay. But think about this. For every dollar you spend on taxes, is the dollar that you cannot invest. And depreciation allows you to accelerate the time value of money by sheltering that income. And even those passive losses that you generate through passive activities like investing in a group syndication pass through to you as an investor, or they can. Again, remember, that's a question you need to ask when you're looking at any asset. Okay, and the passive losses not only can be used to shelter income from that particular asset, they might be able to be used to shelter income across other passive assets that you've invested in. Okay, and maybe even against other passive assets that have sold and have generated a gain. All right, so that's super cool. Okay, those you can unlock those passive income losses that you're getting to create this what we call golden wheel of passive losses to shelter the income, and again accelerate that time value of money. Okay, so if you were invested in a passive deal, what does this look like? How does it work in an investor level? Because the illustration we covered earlier was if you bought your own building. Well, again, this is where you're going to partner with the operator's CPA. Okay, they're going to make all these calculations for you, but they're going to hand you a K1 with a passive loss on it. And that's where your CPA is going to pick up that K1 and start applying it to your personal situation. But here's what it could look like. Say you invested $100,000 into a deal, a passive real estate deal. And the first year, let's just say it threw off 50% depreciation. Okay, and maybe your effective tax rate where you live and based on your personal situation is 37%. Okay, well, based on that $100,000 investment, 50% year one loss, you're creating a paper loss of $50,000. Okay, and if you, at your effective tax rate of 37%, you just generated a savings of $18,500 that you don't have to pay tax on, and that now you can reinvest forward into scaling your portfolio. Okay, so essentially $18,000 for every $100,000 invested, you're getting 18.5% return in your first year alone just from the tax savings. Right? I know a lot of investors are chasing yield right now with cash flow and underwriting the IRR and the equity investment, and that's great. You should be doing that, right? Don't dismiss the power of that tax benefit, because those losses can be used to not only offset the passive income and gains from that asset, but other assets in your portfolio. So as a result, real estate is a very, very powerful tax shelter because of the depreciation. Now, if you guys are watching the video live, you see that there's a note on the screen here, because, if, for a real estate, or sorry, multifamily investment, you might be getting a 50% year one loss. But if you invested in an express car wash deal, you're probably getting closer to a 70+ year one loss, depreciative losses. And for those of you who are interested in that type of generation of year one loss, we've got a deal open right now, our Car Wash 7 deal. So reach out to me at Whitney@passiveinvesting.com and we can talk further about that. All right. Now, a lot of people are like, okay, maybe you're in the same situation. You're like, okay, I get this viscerally. I understand what you're talking about, but I understand that I can use depreciation to offset my income, save on taxes. But maybe you're butting up against one of two myths. The first myth is maybe you're like, if I don't pay my taxes, I'm a bad person. I don't pay what I need to in taxes. Hopefully that is not the case. Hopefully I've done enough education with you that you understand that that's actually untrue. Because when you invest in passive real estate, you're actually shifting how you pay taxes. Okay, because now any taxes that you would be paying are at the asset level, the business level. Okay, so now your taxes, as opposed to writing a check to Uncle Sam at the federal government, you're writing, you're participating in the property taxes and maybe payroll taxes for the property management company, right? You're affecting the local areas and the employees where this asset is. Okay, so again, remember, your taxes might be actually, your taxes, how you pay them, are shifting, and you might actually be creating a larger impact than you would if you sent it on federally. Okay, but there is one fact here. You need to understand that not all operators allocate depreciation equally amongst their investors. So I know I've mentioned this probably 3 times already. Make sure that this question on how do depreciative losses get allocated is in your discussion with operators. Now, I see some questions coming in, guys. If you have questions, if you're here live with me, make sure that you drop them into the Q&A box. We will start our Ask Me Anything session here in a few minutes, but I would love to tackle all of those for you. All right, moving on. There's one thing to consider here, okay, right? Just as much as I'm showing you here how to scale all these depreciative losses, taking advantage of an 80% bonus depreciation tax incentive this year, maybe even tapping into the power of investing in like a business, say like in express car washes right now. There's some considerations for you, right? Depreciation means now you are in, if you take advantage of depreciation, you're now in partnership with the IRS, okay? And that means when you sell that project, you could be, subject to depreciation recapture and capital gains, right? Even as a passive investor, okay? But we're going to show you how to maneuver through these situations, okay? But let's define what that means, okay? Depreciation recapture is, that is the gain received from the sale that is reported as income. So it's a tax on the amount of depreciation that you've taken, okay? Now, this is where we're getting into accountant territory, so we're not going to calculate that out. But that is something that our CPAs will help figure out when an asset sells. Okay, also, just like any other asset, even that $1 million building that we talked about at the beginning, okay, when you sell an asset and the partnership is terminated, the equity gains are distributed and the profit portion is long-term capital gains, okay? Now, if you have a bucket of depreciative losses across other passive assets waiting for you on your 1040 tax form, okay, that's not where they're booked. They're booked on a different page of that tax form, but on your personal tax return, you can utilize those other losses to continue to offset any future recapture or capital gains. That's the power of real estate. Okay, so how do we handle depreciation recapture and capital gains? All right, number one, you could go ahead and pay the gains in the depreciation recapture and go buy a boat or travel the world or do something like that. We call that the poor man's strategy. All right. The reinvestment strategy is you do a 1031 exchange. Okay, that's what we love doing here at passiveinvesting.com is when we go to sell an asset, doing our best to identify another asset that our investors can trade into. We call this the buy, borrow, die strategy. All right. And even if you're listening to this and you sold an asset recently, you're say like your own personal building, and you're like, hey, I've got some money sitting in a 1031 exchange I'd like to place. We might have an opportunity for you to do that too. Okay. Especially if you've got $500,000 or more, or $1 million or more, reach out to us. We could help you deploy possibly a 1031 exchange strategy here in a few months. And then we've got the offset strategy. Okay, this is where you use other passive losses to offset your recapture, and gains. Okay, we call this the lazy 1031 exchange. Okay, it's really utilizing these last two strategies. That is how the 1% build wealth, right? Okay, they are taking advantage of depreciation. They're accelerating forward as much as they can. They're leveraging this bonus depreciation tax incentive. Okay, and then they are continuing to kick that tax can down the road because they understand the time value of money. All right, so we've gone through what is depreciation, why is it important, how do we leverage it, okay, what are some of the considerations here. Now, Whitney, you might be asking me, like, which assets should I be looking at for the best depreciation? All right, well, there's several factors here. How can you maximize this tax benefit? One, it's going to depend on the asset class you go into, and then two, what the strategy is. Okay, so if you go into a multifamily asset, essentially you're on that asset can be depreciated over 27.5 years. Self-storage, it can be depreciated over 39 years. Express car washes, okay, and there's a heavy amount of depreciation. That's why we can get to that 70% year one loss. It's because we can actually take that building and depreciate it this year, okay, as opposed to spreading it out over multiple years, okay? It also depends on the business plan, okay, especially the business plan moving forward. Is it going to be a core business plan where you're just holding the asset? Are you doing some sort of value add strategy, a development strategy, or are you just short hold, you're flipping the asset, where if you're just flipping it, generally you can't take advantage of depreciation at all. The key thing here is that operator must be leveraging a cost segregation study methodology, that accelerated depreciation, before they can, one, tap into the accelerated depreciation, or two, take advantage of the bonus depreciation. All right. So where should you invest now? Where should you place your bets? Okay. Our strategy, what we're doing here, especially we've done this for all of 2023. We're focused on this towards the end of the year. We don't have any multifamily assets closing before the end of the year, but that is our core strategy. Express car washes, we're looking at core plus, value add, and maybe a little bit of a development, and looking for about that year one loss of 70+%. Okay, if you're looking for that right now, reach out to me at whitney@passiveinvesting.com. And then, of course, we've got our self-storage portfolios as well. But keep in mind, okay, you want to make sure at any point in time you're investing in a high quality asset. All right, guys, thank you for hanging with me here today as we talk through the benefits of depreciation and how to leverage that in your portfolio. This is your call to action. If you haven't done so already, make sure to reach out to me at passiveinvestingwithwhitney.com. There you can jump on a one-on-one call with me to understand how passive real estate can help you meet your investment goals and get access to our future masterclasses and priority access to our open deals.